I reviewed your new Q2 crypto report and see that in the quarter, crypto startups raised $2.7 billion dollars across 503 deals. That's a 2.5% bump in invested capital compared to Q1 of this year. Now, that increase came even with a 12.5% drop in deal value. That's different than what we saw in Q1 of this year when there was an increase in both deal value and deal count. But the results mark the third straight quarter of gains as it relates to investment value. So, what do these Q2 numbers signal to you? Obviously, with the drop in deals and more capital invested, the size of the deals in Q2 must be bigger. But why do you think that is? And where is the capital going? What crypto projects got the most investment dollars?
Yeah, so like you said, the deals, the deal count went down, but the total deal value went up to $2.7 billion. So on a deal by deal basis, the check sizes are larger, which means, you see that investors are really doubling down and putting money into those strongest crypto companies, the ones that have been building, through the bear market, over the last 2 years and have gotten to a place now where they're finding traction, they're finding product market fit. They're getting users. So you're seeing the check sizes getting bigger for those specific companies. And we're seeing it's very similar to what we've seen over the last 6 months. Infrastructure deals are getting a significant amount of the money. Layer one solutions, layer two scaling solutions as well. We saw Chain and Monad raise these mega rounds this past quarter. And then so those are kind of like the areas you're seeing in infrastructure. We haven't seen a lot of applications yet, but we do expect applications to be, the next wave of investments that are going to come in the next, 12 to 18 months.
So, what would you say were the driving forces behind the third consecutive quarterly increase in investment values?
Investors have just been much more willing to invest in the space now. We really do step back until last summer when BlackRock filed for the spot Bitcoin ETFs. That's really when we saw the sentiment change with investors in the private markets. A lot of folks were saying, "Hey, look, we think that the bull market's right around the corner. The bull market's coming back." So we saw, investors were more willing to meet with founders that are not part of the portfolio to write new checks. And then from founders, they're finding it easier to meet with investors. And these conversations have really accumulated over the last 6 to 8 months for us to see, the uptick in deal value.
Did you see the same thing when spot Ether ETFs were approved here in the US?
It's a little bit different. I think it's a little bit too early to say. We think that it will drive more investments. But right now, with what's gone in the crypto markets over the last week, a lot of the crypto market is down, so we'll see how that works. But I think overall the spot ETH ETFs was pretty successful. In the first week, we saw $1 billion of inflows into these ETFs. So we'll see if that continues. We don't know if the momentum's going to be strong as Bitcoin when those ETFs started trading back in January. But so far it seems like they're doing pretty well. And then I think over a very long period, over long term, it's going to be really good for the Ethereum ecosystem.
And it certainly will be very interesting to see if that does in fact happen. But do you think the streaks of quarterly bumps in investment values will continue into the next quarter? When we spoke in the past, you noted that crypto VC investments typically rise when crypto markets are doing well. And recently, as you noted, Bitcoin experienced a sell-off and is trading well below its record of more than $73,000 reached back in March. So how will crypto's performance this quarter play into investor interest? And do you anticipate the increase in capital invested will continue, especially with the expectations of lower interest rates in the mix?
Yes, we do expect investors to continue deploying capital into this space. It will continue to increase just because you look at the amount of dry powder that exists in the crypto native venture funds, and venture funds are now coming to market again to raise new funds. So there's fresh capital coming to the market. So I think all of that would push the amount of investments going into the space up. The thing is, I don't expect it to be as strong as it was in 2021 and 2022. Historically, there's a very strong correlation between, private investments into crypto startups and the publicly traded crypto tokens. We saw, the crypto market cap go, very close to its peak back in March, about 93% of its peak. I don't think we'll see private investments reach 93% of its 2022 peak, because 93% would be roughly $25 billion invested. I don't think we're going to reach $25 billion of invested capital into the crypto space over this year or next year. We'll probably get a much higher than the amount invested last year of $10 billion. I think this year we'll probably end somewhere between 12 to $14 billion of invested capital, and maybe next year a little bit more than that, but nowhere close to the 2022 peak, even though the publicly traded tokens reached pretty close to its peak earlier this year.
Interesting. Now, what areas of crypto got the least investment dollars this past quarter, and why do you think that is?
I think that it's been a pretty long-term trend. DeFi continues to get the least amount of invested capital from venture. They still do raise money, but because the mechanisms to raising capital is different. In DeFi, a lot of DeFi protocols come to market by launching a token. Because a token has a lot of value to the DeFi protocol, so they don't necessarily go into the VC markets to raise capital. So VCs still do support some DeFi protocols, some of the really notable ones, like Uniswap last year raised a really large round. So you still see some of those deals, but for the most part, DeFi protocols typically raise money in a different mechanism, so they don't go to VC. So you see the lowest amount of deals going into that space.
Now, I recently put together a report on the integration of crypto and AI, and according to Architect Partners, AI is pulling some investment dollars away from other technologies, including blockchain. Data sent to us from the crypto advisory firm shows that in Q2 of this year, AI private investments totaled more than $40 billion, far surpassing crypto investments. Elliot Chun with Architect Partners told me that he expects the combination of AI and blockchain to be a, quote, powerful go-forward investable theme. Do you agree? And do you think AI is in fact pulling some capital away from blockchain investments?
I think AI generally has been a very hot sector over the last 18 months. So not surprising, with the launch of ChatGPT at the end of 2022. So it generally has been pulling money from anywhere, especially from generalist investors. That's where their attention has been. And, even in the crypto space, the generalist VCs have left. They haven't come back yet. They are definitely looking at the shiny ball, and that's AI right now. Where we think that generalist investors will come back will be at the cross section of AI and crypto. And so, there is a lot of new activities happening. We, in the research, we highlighted decentralized GPU networks, which is the hardware compute infrastructure to help power AI training and AI inference. So that is one area. I think there's many different areas as well that you see, just using blockchains to verify data, or using blockchains to incentivize folks to participate in the AI ecosystem. So there's many different areas, and so we do see a lot more capital coming into that, the intersection of blockchains and AI.
Now, I want to focus on decentralized GPU networks, which your report calls a crucial solution for AI's growing computational challenges. Of course, the explosion of AI with the advent of things like ChatGPT, as you noted, has significantly increased the demand for computing resources. In fact, here in Crypto World, we have been covering the growing trend of Bitcoin miners turning to AI, retrofitting their facilities to service AI clients in an effort to diversify revenue streams. And your report notes that decentralized GPU networks have emerged to share and monetize unused resources. So what are some of the benefits of these networks? What did you discover in your research?
If you look at AI training and inference, one of the primary bottlenecks right now is the availability of computing power out there. And so these networks are trying to support that to provide more supply. And they add the supply by using tokens as an incentive for anyone with spare GPU or a spare CPU to bring that supply and add it to that network. And so, there's many different companies that are doing, previously on the programs in the past, we spoke about Jensen, who's doing that. They have a bunch of different GPUs, and they're incentivizing folks to come on and contribute. And then, so you can do that for AI training and inference. So the main thing is to hope increase supply, decrease cost, and increase efficiency by doing this. The challenge right now is it is in a very early research and development phase still. No one has been able to use these decentralized GPU networks to train AI models at scale, similar to a cluster of GPUs, how OpenAI is training their AI models. So there's a lot of research and development that's going into the space, and we feel pretty bullish in the next 3 to 5 years that some of these networks that we mentioned in the research can achieve that level of scale.
In a nutshell, what would you say is the key takeaway of PitchBook's Q2 crypto report? And is there anything that surprised you?
Yeah, I think overall the sentiment in crypto has changed over the last year. That's our main takeaway, and we see that investors are excited to come back, and investors are excited to invest in infrastructure, middleware and backend stuff. The thing is, we have not seen applications being developed, and we highlight this in the report. You look at 2 cycles ago, most of the investments went into the application layer, right? So the Circle and the Coinbase ago, that's 2 cycles ago. Last cycle was FTX and Dapper Labs and Celsius and BlockFi. This cycle so far, we have not seen a lot of application investments. A lot of it is into the infrastructure. So we still think that looking forward in the next 12 months to 24 months, there's going to be these killer applications that have to come to market that are getting the users, that are serving end users, whether it's enterprise, retail, business users. That is where we're expecting a lot of the value accretion to happen. And so we expect investors to slowly over the next 12 months to 2 years to start shifting away from infrastructure. There's a lot of infrastructure investments. I don't know how much ROI you can get there, but I still think there's a lot of opportunity there on the application side.
And did the lack of application investment surprise you?
Not yet, because I myself haven't seen the killer applications yet. Farcaster raised $150 million round this past quarter. Farcaster, if your audience doesn't know, is basically a decentralized Twitter, very similar to Twitter. They have some different innovations that they've done, like frames where you can like mini applications inside like the text line. And so they're pretty interesting, but the challenge is that they're still serving mostly crypto users. Most of the folks that are using Farcaster are crypto. And so we're looking at who are building a blockchain-based application that is serving non-crypto users. And then so I don't think we're there yet, but once we do get there, we expect that's where the investments to go.